Hi, I'm Kelly Zitlow. I've been helping people realize the dream of home ownership for over 25 years. Have you ever wondered how interest rates affect your mortgage payment? That's what we're going to talk about today. I'll be sharing you how interest rate affects your mortgage payment, as well as what it looks like for the life of the loan. Be sure to stay to the end for my #1 tip on how interest rate affects your mortgage payment. Before we get started, please do me a favor and subscribe to this channel. I truly have a passion for home loan education and I love helping people. So please subscribe and become part of our community. All right, how interest rate affects your mortgage payment. Today we're going to be using a Mortgage Coach total cost analysis to dive deep into these numbers. But before we dive into this, I do want to make sure that people understand there's a difference between the actual purchase price, so the price you're paying for the home, and the loan amount. There's always a lot of confusion around this. So if you're paying $400,000 for the house, your loan amount might be $400,000, let's say, if you're using a VA home loan. It may be $380,000, it may be $300,000. So the loan amount is definitely going to be a different amount versus the actual purchase price unless you are using a no money down VA home loan. For our scenario today, we're going to be assuming a $400,000 purchase price and a 20% down payment. So the Mortgage Coach cost analysis is going to reflect 4 different interest rates. And really the reason for this is that I think it's so important for people to really understand that for every 1 percentage point that the interest rate goes up or down, the impact it's really going to have on the interest paid over time as well as the monthly payment. Because a lot of times people are thinking, well, maybe I'll just wait. Maybe I'll just wait to buy a house for whatever, waiting for the future. It's very likely that interest rates are going to be higher in the future than they are now. We are still at historic lows on interest rates, but that's not always going to be the case. So using this analysis will help buyers truly understand the difference and whether they should wait to buy a house or whether they should proceed now. Okay, so let's get into it. This analysis is going to show a total monthly payment based on each one of these interest rate scenarios. So column 1 is using a 3% interest rate, column 2 is using a 4% interest rate, column 3 is a 5% interest rate, and column 4 is a 6% interest rate. Now many of you may say, really? 6% on an interest rate? That would seem completely crazy. But actually 6% has been an interest rate within the last 15 years. So it's one of those things that just know this country has gone through a lot over the last 15 years. Interest rates have been fairly low, but they are absolutely going to be higher in the future. There's no doubt. First, I do think it's really important to know how a monthly mortgage payment is comprised. Because when we think about a payment, usually a lender is just telling you, okay, that's going to be $1,600 a month. But really, what does that mean? Well, there's several components to an actual mortgage payment. First, you're going to be paying principal and interest. And principal and interest is actually on the amount of money that you're borrowing. So the principal is actually the dollars that you're paying every month that's going to reduce the amount that you borrowed. So every month, the principal portion of your payment is going to go and reduce your loan amount. The second part of the principal and interest is the interest. So that's the amount that you are paying every month based on the interest rate that you locked in at toward the interest of the loan. Property taxes, if you choose to have your property taxes included in your mortgage payment, as well as your homeowner's insurance. And finally, if you're not putting 20% down, yes, I know you don't have to put 20% down, keep that in mind, then you would be paying monthly mortgage insurance. Scenario 1, at a 3% interest rate, the monthly payment with taxes and insurance, and of course we're estimating those as part of this analysis, but we're pretty close on these estimates. So the monthly mortgage payment would be roughly $1,659 a month. So that includes principal, interest, property taxes, and homeowner's insurance, because in this scenario, 20% down payment is the down payment figure that we're using. There is no mortgage insurance. Scenario 2, so for 1% increase in interest rate, that payment goes from $1,659 to $1,837. Again, that payment includes principal and interest, property taxes, and homeowners insurance. So almost a $200 a month change in payment based on the same purchase price, the same down payment. The only difference is now the interest rate has gone up 1 full percentage point. Stay with me, this is really where it gets exciting or crazy. Scenario 3 has a 5% interest rate. So again, going to now take that payment from where we started, $1,659 a month, to at a 4% interest rate, $1,837. At a 5% interest rate, $2,027 a month. And column 4 is going to show a 6% interest rate, which increases that payment to $2,228 per month. This is a great example of just how interest rates really do impact your monthly payment relative to the same purchase price and the same down payment. One of the reasons why I have used Mortgage Coach for so many years as an education tool with our buyers is because it not only shows you the actual payment detail based on different types of scenarios, i.e. different interest rates, but it also shows you what happens over time. And this is really the key. So in this scenario, you will see in 15 years, based on every 1% that interest rate goes up over the 15 years, it equates to roughly a $40,000 difference in interest paid for every 1% the interest rate's gone up. So take a look at this. I mean, it's crazy, right? So if you have a 3% interest rate, in this scenario, in 15 years, you will have paid $118,337 in interest. When compared to a 6% interest rate, the interest paid, same purchase price, same down payment, same loan amount. The only difference is interest rate. If it was 6%, you will have paid $252,961 in interest. This is a great illustration of how interest rates impact the total amount of interest, i.e. dollars, that you're paying over time. What drives an interest rate is really going to be dependent on what type of home loan that you are taking out. If you're using a down payment assistance program, many times those programs have higher interest rates and higher cost associated with them. If you're purchasing a second home or an investment property, those interest rates are higher than if you are purchasing a primary residence. And if you have less than 20% down, the interest rate could potentially be higher. But the number one reason, which is my number one tip, so listen up, the number one reason that your interest rate could be higher at the same point in time, so we're not talking about the future, we're talking about today, is based on credit score. So credit score on a conventional loan together with your down payment, and whether it's a primary residence, second home, or investment property, credit score matters. It truly does. Interest rates based on conventional loans are driven by credit score. The higher the credit score, the lower the interest rate. And if you're not putting 20% down, also know that credit score will also impact the cost of the mortgage insurance. If you want more information about how credit score impacts interest rates, check out the link in the description below. Now you know how interest rate affects your mortgage payment. Remember, it's always recommended to work with an experienced mortgage lender to help navigate the home loan process. If that's in Arizona, California, or Colorado, please feel free to give me a call, or if you have questions, comment below. And don't forget, like, share, and subscribe. We truly believe educated home buyers make educated mortgage decisions. Until next time.